Okay, let's dive right into this explainer. Today we're unpacking the absolutely massive transformation of the UK's largest digital bank, Lloyds Banking Group. If you look at this through a classic Peter Lynch lens, this is your quintessential turnaround story. We're talking about a legacy institution shaking off some serious historical baggage to emerge as a highly profitable, highly modern financial powerhouse.
So, how exactly does a bank go from needing a colossal government bailout to generating a jaw-dropping £18.3 billion in net income? I really want to start by framing the sheer scale of this comeback. Think about it. This was an institution that literally became the poster child for the 2008 financial crisis in the UK. And now, we are watching it climb back to record-breaking profitability. It's a journey that really forces us to look closely at corporate resilience and their incredibly aggressive pivot toward digital banking.
But, and this is the big but, this isn't just some simple victory lap. We're going to examine a very delicate balancing act today. On one hand, you've got historic capital returns and total digital dominance. But on the other hand, you have these looming market risks, domestic economic headwinds, and the very real ghost of legacy litigation dragging on their valuation. It's a complex, fascinating picture, so let's break it down.
All right, Section 1. From bailout to billions.
To really appreciate where Lloyds sits right now, we have to map out its modern era. From its roots all the way back in 1765 as a button-maker's bank, to those super dark days of the 2008 crisis where the UK government had to step in and take a massive 43.4% stake, just a staggering intervention. But look at the trajectory since then. By 2017, they made a full return to the private sector. Fast forward to 2025, and they're issuing record shareholder payouts. It's a complete 180-degree turn from a ward of the state to a standalone profit engine.
And the sheer volume of their 2025 net income is just staggering. £18.3 billion. That represents a really robust 7% growth over the previous year. What's driving that? A higher banking net interest margin and broad-based growth across their underlying income. Basically, their core banking engine is running incredibly hot and, more importantly, incredibly efficiently.
Crucially for investors, management didn't just sit on those massive operational profits. They translated them directly back to the shareholders, returning a whopping £3.9 billion for the 2025 financial year. This features a highly aggressive $1.75 billion share buyback program paired with a 15% dividend hike. For value investors, this is the ultimate proof of cash generation and seriously disciplined capital allocation.
When we look at the hard data, statutory profit before tax jumped 12% to $6.66 billion. But I really want you to pay attention to the return on tangible equity, or ROTE. That's a key measure of how effectively the bank is actually using shareholder money. It climbed to 12.9%, and actually, if you strip out certain remediation charges, their underlying return was closer to 14.8%. That puts them right on the doorstep of that elite 15% benchmark that top value investors always look for.
Moving on to Section 2, the digital and AI shift.
Lloyds is achieving some incredible operating leverage right now through an incredibly aggressive digital shift. They're officially the UK's largest digital bank, boasting 21.5 million active app users. That's a massive 45% increase since just 2021. They're successfully moving a huge legacy customer base right into a mobile-first environment, which radically reduces their cost to serve. Honestly, this perfectly mirrors Philip Fisher's framework on leveraging market scale through rapid technological adaptation. And they're not just getting users on the app, they are deepening that customer engagement very strategically. We're seeing moves like migrating Halifax customers seamlessly into the premium Lloyds digital ecosystem. By offering perks like Club Lloyds Interest, the mass affluent Lloyds Premier account with health benefits and cashback, and zero debit card fees abroad, they aren't just holding on to customers, they are actively upselling them. Plus, they are fully integrating a next-generation AI financial coach right into the app to personalize the whole experience.
Now you might think, oh, AI, that's just a buzzword. But this isn't just some tech gimmick designed to sound good on an earnings call. Leadership explicitly states that this AI integration is expected to generate over £100 million in immediate added value in 2026 alone. We're talking about powering everything from smarter commercial underwriting to way faster customer service.
Furthermore, this whole technology-first mindset has absolutely slashed their operating costs, driving a massive £1.9 billion in gross cost savings over the last few years. By retiring clunky legacy technology and increasing the number of active customers served per employee by about 50%, they've built a highly efficient scale model. In fact, they're aiming for a cost-to-income ratio below 50% for 2026. For a legacy retail bank, that is an incredibly strong position to be in.
All right, let's turn to Section 3, the Motor Finance Cloud.
As objective analysts, we have to look at the storm clouds on the horizon here. We need to neutrally examine the Financial Conduct Authority's ongoing investigation into missold car finance. Basically, this redress scheme was set up to evaluate and compensate consumers over historical commission structures. And as a massive player in auto finance, Lloyds is sitting right in the center of this sector-wide hurdle.
The scale of this issue is stark. Let's put it in perspective. Lloyds reported a stellar first quarter in 2026, with pre-tax profits climbing to over £2 billion. Amazing, right? Well, that entire quarterly profit is effectively neutralized by the roughly £2 billion they've had to provision specifically for this compensation scheme. It really shows how years of hard-fought digital efficiency can essentially be wiped out in a single quarter by historical regulatory fines.
The slight silver lining for investors here is that by keeping these estimates capped around that £2 billion mark in their recent updates, the bank is at least avoiding a catastrophic repeat of the PPI scandal. For some context, that historic payment protection insurance scandal ended up costing the bank a staggering £22 billion over time. The market was definitely holding its breath, waiting to see if motor finance would spiral to those PPI levels. But at least for now, it seems contained.
Which brings us to Section 4, Valuations and Market Headwinds.
Let's explore how these competing forces are actually affecting the stock's valuation today. As Morningstar highlights, Lloyds is facing a bit of a reality check, experiencing a year-to-date share price drop in early 2026 of 3.8%. Because Lloyds is a pure-play UK bank, it completely lacks international arms to offset domestic slumps. That means it is intensely vulnerable to strained household finances, shifting Bank of England interest rates, and of course, political and tax uncertainties over in Westminster.
And here is the valuation reality check as of mid-May 2026. The stock was trading at roughly 94 pence per share. That sits just a hair under Morningstar's fair value estimate of 97 pence. If we think about this in Benjamin Graham's terms, there is virtually zero margin of safety right now. Despite the massive profits and huge buybacks, the market has priced the stock almost exactly where analysts believe it should be, heavily discounting it for all those macro and litigation risks we just talked about.
Furthermore, analysts are quick to note that despite its massive digital scale and those 21.5 million app users, the bank still lacks a wide economic moat. It's operating in an incredibly saturated, highly competitive UK retail banking environment. Its competitors can, and absolutely do, offer similar digital features. That means Lloyds has to constantly fight tooth and nail to maintain its market share and pricing power.
So, I'm going to leave you to weigh the evidence from this explainer. You have a bank that successfully transformed from a bailed-out liability into the UK's most profitable, digitally efficient banking leader. Yet it's still completely tethered to a sluggish domestic economy and these multi-billion-pound regulatory provisions. With record profits, but some seriously heavy risks. Is this a classic turnaround buying opportunity just waiting for a catalyst, or is it a dangerous value trap? It's a fascinating question and one the market is actively trying to answer right now.